Hello traders! In this video, we will unveil a high win rate breakout and divergence strategy. For this strategy, we'll be using the RSI together with the Bollinger Band indicator. This will give us high probability confirmations, and if used correctly, this combination is able to show us unique entry points through market shifts in a very readable and visible way. Both of these indicators generate signals based on price exhaustion and momentum. They are often used to interpret a change of character in price and alert for price reversals. With that said, let's go straight into the video. First of all, what are the Bollinger Bands and how do we use them in the market? This is a very simple to use indicator. Bollinger Bands help determine whether prices are high or low on a relative basis. This indicator is easily distinguished by its upper and lower deviation lines, which retain price in between them. This advises price reversals and helps us identify when aggressive or irregular movements leave the price exhausted and potentially reversing. So, if we study this indicator correctly, we will see that when we get a break from the Bollinger Bands and price tries to push away from these lines, sooner or later it comes back into the range, pushing candles strongly to the other direction from the one it came from. This happens over and over throughout time, so we'll be focusing on two important concepts: bullish deviation line breakouts and bearish deviation line breakouts. However, the pair of bands is not intended to be used on its own. This should be used to confirm signals given with other indicators like the RSI, which we will talk about later in this video. After we identify higher highs or lower lows correctly, we can use this indicator to take advantage of market impulses and trade with price's momentum. We can either use these concepts within a reversal or a continuation in price. Easy, right? Well, how it works is very self-explanatory. Unfortunately, we cannot only guide ourselves just by a breakout from the Bollinger Bands. Trading every single breakout might lead to a low win rate and unnecessary losses in the long run if not performed properly, as there are many times where this indicator will give us false entry signals. In this example, we see that the price broke the upper deviation line multiple times, but as the price was not on a bearish trend by that time or at a valid reversal zone, every short position got liquidated in a matter of minutes. This is one really important thing to keep in mind when using the Bollinger Band indicator. Not every break from the range means a reversal. With that being said, let's get into the next steps and find out how we can increase this trading strategy's probability even further using our additional validations. Understanding the RSI indicator. The second indicator is the RSI, which stands for Relative Strength Index. This indicator is built to represent, or at least give an approximate of when an asset is at an overbought or oversold price in the market. We can see that this purple line moves between the 70 and 30 RSI level. If the line reaches over 70, it means that the market is already overbought in the eyes of most retail traders. On the other hand, if the line reaches below the 30 level, for most retail traders, this would mean that the price is oversold. However, trading the RSI only based on overbought and oversold levels is not a high accuracy confirmation, as there are many times where this indicator will give us false entry signals. Thereby, we should not trade based just on this theory. There is a much greater way to use this indicator when just focusing on overbought and oversold levels. This method is called divergence. What is a divergence? A divergence is when an asset's price is moving in the opposite direction of an indicator. Divergence warns that the current price trend may be weakening and in some cases may lead to the price changing direction. Normally, an asset's price and the RSI lines go in the same direction, but if, for example, an asset is showing higher highs but the RSI indicator shows higher lows, we call this a divergence. Divergence is when the asset's price and the RSI line stop correlating and start going different directions or diverging. This signals that the price is exhausting and is willing to reverse from where it is. So in addition to just using the RSI to look for overbought and oversold signals, we are going to trade divergences. Okay, so by now you've already learned how the RSI indicator works, what a divergence is, how Bollinger Bands interact, and also make sure to understand that not every breakout or divergence is an accurate entry. So, We are going to merge all the concepts we have learned until now, and this is going to assemble into our complete strategy using the Bollinger Bands and the Relative Strength Index indicator. We want our confirmations to develop fully in order to have a valid signal. The confirmations we want are a valid break of the upper or lower Bollinger Band and a valid divergence between our RSI and the actual price, both doing opposite higher highs and lower lows. As we can see in this example, price pierced through the upper Bollinger Band and it formed a clear divergence, which is valid. This would be enough information to enter a trade. As you can see, this strategy is able to catch really good risk-to-reward ratios and also maintain a high win rate, as price is not always showing these two confirmations between our indicators all the time. Therefore, chances of just considering a trade are tighter, and so is our losing probability. Let's take a look at another example. In this scenario, we can clearly see a valid break of the Bollinger Bands, meaning price has to slow down and start reversing. Now, to enter a trade, we need our other confirmations, which is the RSI divergence. So in order to have a valid and high probability entry, we would have to wait for the divergence to form. As soon as we get our second signal, we can safely place our long trade and look for bullish bias. You can add simple support and resistance zones to add probabilities to your strategy and increase your win rate even more. Always keep in mind that although this is a really simple method, it has to be followed accordingly. Otherwise, we're going to end up losing money in numerous trades if we don't apply these rules correctly. Remember, we always want to trade in line with the market trend or a really valid reversal. And that for a reversal to be valid, the price has to clearly go opposite ways from the RSI showing a divergence, and it also has to pierce through the Bollinger Bands. Let's look at the next example. On this example, we are on a clear bearish trend, which means we would be looking for sells or only for good quality reversal signals. This is where most inexperienced traders lose their patience and their money, trading against the trend. If you would have drawn this divergence between the price and the RSI, it would have been a valid divergence. Nonetheless, this does not mean it is a valid entry. If we would have placed a sell entry on this point, we would have unnecessarily lost the position within the next candles. As you can see, Bollinger Bands were just tapped by a wick, not pierced, which means this is not a valid breakout. The result is just another lesson learned. There are many scenarios where we could watch these same patterns over and over again. I will encourage you to backtest this strategy on your own so you can see by yourself the powerful results it provides and start trusting a truly reliable trading strategy. This brings us to the end of the complete breakout and divergence strategy explanation. If you like this information, you definitely don't want to miss out on the upcoming videos. See you next time.